the hidden machine behind your money, how banks create cash from nothing. Before we begin, like this video, share it with someone who loves hidden systems, and subscribe to Uncovering Facts, because today we're exposing the financial magic trick that runs modern civilization. Most people believe money works like this. You deposit cash, the bank stores it somewhere, and later it lends your money to someone else. That mental picture feels comforting. It sounds physical. It sounds real. But here's the unsettling truth. Most of the money you use isn't physical at all, and banks don't simply lend your deposits. In the modern system, banks create most money by typing it into existence. Not counterfeit money. Not illegal money. Real, spendable money, created through normal bank lending. And once you see how it works, you'll never look at your bank account the same way again. Number 1, the great illusion. My money is sitting in a vault. Imagine you walk into a bank with cash and deposit it. You might picture your money going into a vault with your name on it. But banks don't work like storage lockers. Your deposit becomes part of the bank's balance sheet. And here's the shocker. Your deposit is not your asset inside the bank. It is the bank's liability. That means from the bank's perspective, your account balance is money the bank owes you. It's like an IOU, an enforceable promise that you can withdraw cash or make payments. So when you check your balance and see 200,000 Nairas, or $500, what you're actually seeing is a number that represents the bank's promise to pay you on demand. And that leads to the next question. If deposits are promises, where does the bank get the power to make so many promises? Number 2, the biggest secret in plain sight. Loans create deposits in the modern system. The famous line is this: banks don't lend deposits. Banks create deposits when they lend. Let's walk through a simple example. You apply for a loan, say, $10,000, to start a small business, pay school fees, or buy a car. After checking your income, your credit history, and your ability to repay, the bank approves you. Now, what happens next is not what most people imagine. The bank does not go into a vault, grab someone else's savings, and hand it to you. Instead, the bank does something that feels like a cheat code. It creates a deposit in your account. $10,000 appears as a new balance. You can now spend it, transfer it, swipe it, pay someone. And the moment you spend it, it's treated as real money throughout the economy. So what did the bank give you? It gave you newly created bank money, a deposit, backed by your promise to repay the loan. This is not a metaphor. It's standard accounting. Number 3, the balance sheet spell. It's not magic, it's double entry accounting. Banks create money using a simple accounting mechanism called double entry bookkeeping. Every transaction has two sides. One side is an asset. The other side is a liability. When the bank issues a $10,000 loan, the bank records the loan as an asset, because you owe them $10,000. The bank records your deposit as a liability, because the bank owes you $10,000. So the bank's balance sheet expands on both sides at the same time. No physical cash moved. No other customer's deposit was taken, but spendable money was created. This is why modern money is sometimes called credit money, because it's born from credit. Your loan creates your deposit. Your debt creates your money. And the economy runs on this cycle at enormous scale. Number 4, but wait, does that mean banks can create infinite money? If banks can create deposits by lending, it's tempting to think they can print unlimited money and become unstoppable. But banks are not all powerful. They are constrained, hard. Banks can create money, yes. But they can't create it recklessly without consequences. Here are the real limits. Limit 1. Credit-worthy borrowers. The bank can only create money profitably if borrowers repay. If banks lend to people who can't repay, those loans become bad assets. Losses pile up. The bank's balance sheet rots from the inside. So the first limit is simple: finding borrowers who can pay. Limit 2. Capital requirements. Shock absorber. Banks must hold capital. Think of it as a cushion that absorbs losses. If a bank's loans go bad, capital gets eaten. If capital falls too low, regulators step in, investors panic, and the institution can fail. So even if a bank wants to create money through lending, it needs enough capital to support the risk it's taking. Limit 3. Liquidity and payments. Creating deposits is one thing. Settling payments is another. If you take your new $10,000 and transfer it to someone who banks elsewhere, your bank must send funds through the payment system. That requires liquidity, the ability to settle with other banks. Banks handle this using central bank reserves and interbank markets. So banks can create deposits, but they must still manage settlement. If they can't settle, trouble begins. Limit 4. Regulation and supervision. Banks live under rules, risk limits, stress tests, reporting requirements, and supervision. In many countries, regulators watch bank balance sheets the way airport security watches luggage, not because nothing bad happens, but because something bad can happen. Limit 5. Profitability and interest rates. Banks lend because they expect profit, interest income minus losses and costs. If the economy is weak, interest rates are high, or default risk rises, banks tighten lending. Money creation slows. So the money machine doesn't run at a constant speed. It speeds up in booms and slows in bad times. That's part of why economies cycle. Number 5. The role of the central bank, the quiet power behind the system. Now we reach the next layer of the hidden machine, the central bank. The central bank doesn't usually give you money directly. Instead, it influences the system that creates money, mainly through setting interest rates, supplying reserves to the banking system, and acting as a lender of last resort in crises. Here's the key idea: commercial banks create deposits. Central banks create reserves and cash. Deposits are the money you use daily. Reserves are the money banks use to settle between themselves. Most people never see reserves. The public uses deposits. Banks use reserves. So when you transfer money to another bank, the payment system often requires banks to settle using reserves at the central bank. That's why central banks matter. They keep the plumbing working. Number 6. What about fractional reserve banking? The part everyone gets wrong. You've probably heard this famous story. A bank keeps 10% of deposits as reserves and lends out the rest, and then the next bank lends out more, and money multiplies like a chain reaction. This is sometimes called the money multiplier. It's a popular explanation, but it can be misleading. In real modern systems, banks typically lend first, and then obtain the reserves they need to settle payments afterward. Reserves don't usually limit lending the way the textbook story suggests. Instead, lending is constrained mainly by capital, risk, and profitability, and the central bank provides reserves to keep interest rates and settlements stable. So the system isn't simply bank receives deposits right pointing arrow bank lends deposits. It's closer to bank finds borrower right pointing arrow bank creates deposit right pointing arrow bank manages reserves and settlement afterward. That's why banking is powerful, and why it can also be dangerous when risk is misjudged. Number 7. So what is money, really? Here's where things get philosophical. In the modern economy, money is not mainly a physical object. It is a social agreement recorded in ledgers. Your bank balance is, in essence, a claim on the bank, accepted by society, spendable because everyone trusts it. Money is trust, structured into institutions. This is why financial crises are so violent. They are crises of trust. When trust breaks, the numbers in accounts become terrifyingly fragile. Number 8. How money gets destroyed if loans create deposits. What happens when loans are repaid? money can be destroyed. When you repay principal on a loan, the bank reduces the loan asset and the deposit, or cash, used to repay it. The balance sheet contracts. The created deposit disappears. That means money supply can shrink when people pay down debt, banks reduce lending, or borrowing collapses. This is why downturns can become self-reinforcing. Less lending means less new deposit creation, which can slow spending, which weakens businesses, which reduces creditworthiness, which reduces lending further. A feedback loop. Number 9. What happens when loans go bad? When borrowers default, banks face losses. The bank's loan asset becomes impaired. If losses exceed capital buffers, banks can become insolvent. And when banks fail, or even appear likely to fail, depositors may panic. This is the classic bank run. Too many people demand cash at once. Banks are built on the assumption that not everyone withdraws at the same time, because banks use funds in longer-term assets like loans. To reduce panic, many countries use deposit insurance and central bank support. These are designed to prevent fear from killing healthy banks. But history shows, when trust evaporates, even solid institutions can wobble. Number 10. Why this money machine shapes your life. This isn't just a fun fact about finance. It affects everything. It affects inflation. When lending grows rapidly, deposits expand, spending can rise, and inflationary pressure can build, especially if production can't keep up. It affects housing prices. When banks expand mortgage lending, more people can bid on homes. More credit chasing limited houses can push prices up. It affects inequality. Those closest to new credit, big firms, asset owners, well-connected borrowers, can benefit first. Asset prices can rise before wages do, widening gaps. It affects crises. When banks lend too aggressively during booms, balance sheets become fragile. When the cycle turns, credit tightens, and the economy can slump hard. Modern capitalism runs on credit. And credit is created by banks. Number 11. The 60-second reality check. So you don't get tricked online. You'll see extreme claims online like, banks print money out of thin air, so money is fake. Or, banks can create infinite money, so debt doesn't matter. Those claims mix truth with distortion. Yes, banks create deposits by lending. But no, they can't do it infinitely without limits. Debt matters because defaults destroy balance sheets. Money is real because society collectively accepts it and states enforce the rules of the system. The system isn't a scam in the simple sense. It's a powerful tool, capable of funding growth, but also capable of fueling bubbles and crashes. Number 12. The bigger picture. You're living inside a giant ledger. If you zoom out far enough, modern civilization looks like this. People, firms, and governments make promises to pay. Banks record and circulate those promises as spendable deposits. Central banks manage the stability of the settlement system. And the entire economy rises or falls based on confidence, regulation, and the quality of those promises. That is the hidden machine behind your money. Not a vault. Not paper notes. A network of balance sheets and trust. Closing, the truth about cash from nothing. So, do banks create money from nothing? They create it from something very specific, from a loan contract. From your promise to repay. From the legal and institutional trust that society grants to banks. It's not magic. It's accounting, law, and confidence, working together. And once you understand this, you start noticing how often the world is shaped not by physical resources, but by credit. Because in the modern age, the power to create credit is the power to shape the future. If this documentary changed how you see money, like this video. Share it with someone who still thinks banks just store cash in a vault. And subscribe to Uncovering Facts, because the most important systems are often the ones hiding in plain sight. Now tell me in the comments, What shocked you most? Banks creating deposits, deposits being bank liabilities, or how money disappears when debt is repaid?